Hi, and welcome to the webinar on recession-proofing your finances. I'm Laura Suter, personal finance analyst at AJ Bell, and I cover all manner of issues relating to your personal finances, so debts, savings, cash, and investments. And so before we get started today, there's just a few things that I wanted to cover off. So at the end, we'll have a question and answer session, and we'll try to answer as many questions as possible. If people have more questions, then you'll get an email after the webinar, and that will have an email address on it where you can send your questions. An email will be sent an hour after the webinar asking for you to fill out a feedback form, and it will give information on where you can download today's slides. If you don't see that, then please do check your junk folder, as it might go on into there. And also the session is recorded, so a video will be available on the website in the next week or so if you wanted to rewatch any parts or catch up on any of it. And then the other thing is just to quickly run through a risk warning before we start. So some things that you should bear in mind as we go through this is that the value of your investments can go up as well as down, and you may get back less than you originally invested. We do not offer advice, so it's important you understand the risks. If you're unsure, please consult a suitably qualified financial advisor. Tax treatment, including tax relief, depends on your individual circumstances, and the rules may change. So with that out of the way, I can move on to the rest of the webinar. So a quick run through of what we're going to look at today. So we're going to look at COVID-19, the coronavirus crisis, the impact that it's had on people's personal finances. We'll then look at the bigger picture of the UK economy and the looming recession and some of the predictions around that. We'll then also look at the 5-step plan to recession-proofing your money and the steps that you can take at the moment to get your finances in better order. And then at the end, we'll finish with a question and answer where people can ask questions, and I will do my best to answer all of them. So firstly, if we look at what COVID-19 has meant for our personal money. So there's a wealth of information out there at the moment looking at the impact that coronavirus has had on all of our money. And we've got figures from the government, from the Bank of England, from the Office for National Statistics, for example, as well as a host of other sources. And so if we look at some of these figures, these are just a snapshot from the Bank of England, but they give an example of how people's finances have been affected so far. So these figures look at April, which was particularly important because it was the first full month of lockdown. So lockdown started in March, but didn't cover obviously all of that month. So April gives us the first full month of figures. And lots of the stuff in that month is very positive. So if we look at the figures, almost £7.5 billion worth of debt was paid off by people in April, which is a record sum. And of that, £5 billion of credit card debt was paid off in the month. Now, to give you some comparison, in March, people paid off £2.4 billion of debt, which in itself set a new record. And normally, each month, we usually see about 300 million paid off. So when you compare those figures, you can see the scale of the debt being paid off during lockdown. And this is because a lot of people are saving money during lockdown. So they may not have seen their income affected at all by the current crisis. And then they're saving a lot of money each month on some of their usual costs. And so that means they have more ability to pay off debt. It's important to frame that 5 billion, particularly the 5 billion of credit card debt paid off, frame that and put it in context. So there's still £64 billion outstanding on credit cards as a nation. So we've still got quite a long way to go, but that is a decent proportion of it. And alongside that, people were also saving money. So in April, we saw £16 billion put into savings. So whether that's people just building up money in their current account or putting it actively in savings accounts. And that is more than triple the usual amount. So usually that averages out at about £5 billion a month over the previous 6 months. That was the figure. So there we can see the real impact on people's personal finances of the current crisis. And another stat to come from this was that there was a large drop-off in mortgage lending in April, but that was largely due to the housing market having effectively ground to a halt during the month because people couldn't go and view properties, people were much more restricted in their ability to move, and some deals fell through. And so we've looked at the impact on personal finances as well. And so AJ Bell has done some research of the general public. And what we start to see here is a real split nation. And I think these figures are a really good example of how different households have been affected by the crisis. So in one camp, we have the people that are able to save and financially are actually having a fairly good lockdown, all other stuff aside. So they are likely to still be on their full salary. They're able to work from home during this time. But at the same time, they've also seen a cut to their costs. So whether that's commuting costs or their childcare costs have reduced, for example, while nurseries are closed. And obviously their ability to go out and spend money on things like going to the cinema or eating out or holidays has been cut. And so what we found is 70% of people had saved money during lockdown purely by their inability to go out and spend that money. And so for lots of those people, it's a very positive time at the moment for them financially. But on the flip side of that, we have people that have been really affected by the current crisis. So 30% of people have already had to dip into their savings to pay for bills and food and rent, for example. And 20% of people have had to take on debt to cover those essentials. So whether that's credit card debt or borrowing money from family and friends. So when you think about that, that's a fifth of the population that has already had to take on additional debt as a result of the crisis. And what we're also seeing is that that's disproportionately affecting younger households. So those people aged 18 to 34 are more likely to have taken on debt or dipped into their savings during the current crisis. And a part of that is because younger people are more likely to work in those industries that have been harder hit by the lockdown. So they're working more in retail, in hospitality, or in freelancing, for example. But also they will have had less time to build up financial reserves in order to get them through the current crisis. So less time to build up savings pots and a kind of cash pile to help them get through. And another factor is that they're more likely to be in a group that's renting rather than with a mortgage, and the support out there for renters has not been as great as those for mortgage holders. So they've been hit a bit there as well. However, it's not as clear cut as those that have managed to carry on working doing well, and those that have seen their income hit or be furloughed doing not so well. So our research also found that even quite a lot of people that have been furloughed so may have seen either a cut to their income or their employer may be topping up their income to that 100% point. A lot of those people are still able to save because while they might have seen a fall in their income, they've seen their outgoings fall by much more, so they're still able to save. So what we've got is quite a mixed picture of some people that are doing well and some people that aren't, and they don't necessarily fall in very clear camps. And so then if we look at the bigger picture, so we look at the economy and where our economy is headed. Obviously, a lot of this is based on forecasts and estimates. It's not clear cut yet, but the Bank of England itself has forecast that the UK economy will shrink by 14% this year. Economists are a bit more optimistic about that. They're still predicting that the UK economy will shrink, but by less this year, and then that it will grow next year. We've already had figures out for April showing that the economy or GDP shrank by more than 20%. And that has caused lots of estimations of the fact that we're heading into the worst recession for hundreds of years. We don't actually, while lots of signs point to the fact that we're headed for a recession, we can't actually categorize as being in a recession yet, because a recession has a very strict definition around it, which is defined as 2 consecutive quarters of falling GDP. So that means things like working, spending, investing, trading falling for a prolonged period of time. And because we haven't had those 2 quarters yet, we can't officially categorize as in that, but lots of the signs point to that. But for lots of individuals, these kind of big picture figures around what's happening to the economy or GDP don't really feel like they directly impact them. What matters more to individuals is what's happening with their job, what's happening with their pay, and what's happening with the cost of living. And so there's various predictions around that unemployment is set to rise by around 1.5 million people to 3 million people unemployed this year, and then rise again by a smaller amount next year as well, as we see kind of the tail end of the impact of coronavirus hit. And so that perhaps indicates that those figures and estimations perhaps indicate that not all businesses will be impacted straight away. Some will be able to reopen after lockdown, but then there might be kind of delayed layoffs as those businesses struggle to continue and close down further down the line. But one other factor is that inflation is expected to drop. So that's the cost of goods and the cost of everything that you buy in your shopping basket, and that is expected to fall towards zero in the coming months in this year. And so that's based on Bank of England's own estimations. So when you think about the target for inflation being 2%, if it's around 0%, then that's obviously much lower, and that means that we won't see such rises in goods. But it's important to stress that all of these are estimations, they're predictions of what will happen, but they are not set in stone, and a lot of it, time will tell the impact of these. So if we get on to what all of that means for your money, so we will go through the 5 steps that you can take to fixing your personal finances ahead of any recession. And even if you're not as convinced that a recession is going to come, or you don't necessarily feel like you will be as impacted by it, these are good things to carry out every year or so anyway, as a kind of spring clean of your finances. Lots of people are finding that they've got a bit more spare time at the moment during lockdown. And so these are good things that you can do anyway, but particularly they're good to get your finances shipshape for any recession or any hit to your finances that you might have. So we're going to look at things like debt, building up cash levels, cutting outgoings, and working on side projects or ways of generating money. So the first thing to always look at when you're looking at overhauling your finances or even spring cleaning them is to look at your debt levels. So if you've got any spare cash, then you should be directing that first to paying down any expensive debt that you have. There's little point in saving lots of money or starting investing, for example, if you've got really expensive debt that you're paying off each month. Your balance of how much you like to have in savings versus how much of that you want to use to pay off debt is personal, depends on your circumstances, and it depends on kind of how you feel about that and what motivates you to pay off your debt. So there's no hard and fast rule there, but generally, particularly with interest rates so low at the moment, there's little point in having lots of money in cash while you're paying really high interest on debt. So if you've got debt, then the first thing you should do is write down how much you've got in different places, whether that's credit cards, overdrafts, personal loans, any store cards that you've got, any money that you owe to family and friends, for example, writing down each of those and then writing down the interest rate that you're paying on each of those. And what you want to be doing is not listing it in order of how much you owe to each people, but or each organisation, but the interest you're being charged on it, because what you want to do is start paying off the most expensive debt first and then work towards your cheaper debt. And so you need to list that money and list all of those balances out, and then work through that and pay off the stuff that's costing you the most first. But you can also focus on switching to cheaper rates. So, for example, if you know that you're not going to have much spare cash in the short term, and you know that your ability to pay off that debt is a bit reduced, then your best route is to switch to cheaper rates. And actually, this is a good route to take anyway, even if you know that you'll be able to pay off your debt in the next 6 months or year. The more you can reduce that interest rate by, it means that the payments that you're making each month, less of that will go towards servicing your interest and more will go to actually paying off the debt that you owe. And so interest rates are at record lows at the moment, which is not great for savers, which we'll come on to later. But it does mean that the debt rates certainly shouldn't be rising, although I'm not sure we've seen a dramatic fall in them, but they shouldn't be rising. And it might mean that you can get a much cheaper rate than what you're paying at the moment. So look at things like 0% credit cards, or just switching to a different type of debt that is cheaper. You obviously need to look at the pros and cons and the terms and conditions of all of these. But it's a very good route to, you might find it quite easy to switch your debt. And lots of people think that if they've built up debt somewhere, for example, if they have an overdraft with their bank account, they might think that that means that they're not able to switch accounts and that they're not able to get a cheaper rate. But that isn't the case at all. Your ability to access cheaper debt depends a lot on your credit record, which is based on lots of different things to do with your finances in the past and any missed payments you've had and your ability to pay off finances. But it's definitely worth looking into, seeing what options you have and seeing how much that could save you and whether switching is a good option. Another thing to bear in mind, if you've got an overdraft, then you need to be aware of interest rate rises. So some changes were announced by the regulator before the coronavirus crisis hit. And that meant that lots of people were going to see their interest rates on their overdrafts soar. So for lots of people, they were going to double. Most of those have been put on hold during the coronavirus as a part of the package of measures announced by the government. But you need to be aware, if you do have overdraft borrowing, you need to look into how much that's going to cost you in the future when those measures are over, because they are only temporary. And you need to keep an eye on that, because you might find that the costs of that really start to soar, and it's probably beneficial to move that debt elsewhere. And then the other thing, particularly at the moment, is to check for any help that your bank or provider can offer you. So as a result of the coronavirus crisis, payment holidays are available to lots of people, and this is on lots of different forms of debt and takes different forms depending on what debt you have. But it means that it's a good way of giving people some breathing space. You need to be aware of the costs of it over the long term. It's not a free option, but if you're particularly struggling at the moment, then it can be a good option. So once you've sorted out your debts, then your next route should be to build up your cash. So you want to build up a savings pot of money that you can fall back on should times get tough. And if you keep seeing talk about how much you should be saving and you feel bad because you've got no cash savings at the moment, then don't worry, you're not alone. So 1 in 8 adults in the UK have no savings at all, and almost half of the population have less than £2,000 in cash. So if you feel like your cash savings is quite low, then don't worry, you're not alone. But it's good to have a target in mind. So whether you're just starting out or whether you've already got a decent amount in savings, it's good to have a target in mind of what you ideally should build your pot up to. And if you haven't started yet and you want to start out, then I would say just put away, start with a little amount if that's all you can afford, and just start putting away some money, because it gets you into a really good savings habit. It can be quite motivating to see your pot of money grow each month. And then as you get any kind of additional money coming in, you can add to that. So to work out how much cash you should ideally have, the ideal is between 3 to 6 months expenditure. So the important thing is to focus on there is its expenditure. So it's money you're shelling out each month. It's not your income that you've got coming in each month. And you need to look at your essential outgoings. So this means you need to look at things like your mortgage or rent, your essential bills, so not the kind of fun stuff, but the more boring everyday bills that you have to pay, like your energy provider, TV license, internet, things like that. Council tax is another bigger one. So you need to add up what all of those are each month. And then you times that figure by 3 or you times it by 6, and that gives you your parameters of how much you should ideally save. Now, for some people, particularly that figure times by 6 can seem quite high, and you shouldn't necessarily be daunted by that and think, well, there's no point in starting because, as I said before, starting is the best thing that you can do, even if you're starting off small. But that gives you a guideline, and then that effectively acts as your financial cushion. So if you see your income fall, or if you have any unexpected costs, or if you fall ill, for example, all of the things that you don't want to happen but could happen at some point, it means you've got money there to pay your rent or your mortgage or for your essentials until you get back on your feet. But the main thing that you also need to bear in mind is this money should be readily available. So it's money that you want to be able to access in an emergency at short notice. So it's not money that you should be investing in the stock market. It's not money that you should be tying up in an account that has a certain notice period before you can withdraw it, or tied up for 1 or 2 years, for example. It should be in an easy access cash account. Unfortunately, those are the accounts that are offering very low interest rates at the moment. So you're not going to be earning much interest on that money, which is quite frustrating if you were kind of fighting hard to save that money. But it's important that you can have easy access to it. So I think rates at the moment are hovering just over 1% of interest. So it's not going to pay you out much. But what you want that money for is not generating you massive returns. You want it there as an emergency pot to fall back on that you can easily access. So your next step should be slashing your outgoings. So lots of people think that this is a bit of a boring task and put off doing this, but it can be really important and a really good way of saving money immediately. So if you think that you don't have much money available each month, this can be a really good way of boosting it effectively for free, boosting your disposable income. So what you need to do is get out your bank statements and look at what you're paying for each month. So this is looking at the same kind of essentials and monthly costs that we were talking about adding up before. So your expenditure, your essential expenditure, and looking at where you can make savings with that. So one of the big areas where you can make savings is with your mortgage. So if you're a homeowner and you've got a mortgage, if you can switch that to a cheaper rate, then that is where you are likely to be able to save the most amount of money. So this is an area where you're likely to be able to save the most amount of money purely because it's likely to be most people's largest amount of borrowing. So if you can reduce the interest rate on that, then you are likely to be able to make bigger savings. So lots of people have fallen onto their lender's standard variable rate, it's called. It's often shortened to SVR. And this is effectively the interest rate that you fall on when you've come off any fixed term deal or any introductory offer. And these interest rates are far higher than what you would be able to access in the market or what you would have been paying before. So often they can be double or triple what the best rates in the market are at the moment. We talked a bit about the Bank of England having cut interest rates. One advantage of that is that mortgage rates fall in line with that, and so you should see some pretty attractive mortgage offers out there. So if you're able to switch, then that can be a big saving each month. Obviously, your ability to switch, it really depends on your individual circumstances. So it depends on a lot of factors that may have changed since you last took out a mortgage. So whether your income has changed, or if you're in a couple, whether one of you has stopped working or gone back to work, the value of your house and the amount of equity that you've got in it. So it depends on lots of different factors, but it's definitely worth looking around and seeing what options might be available to you, or speaking to a broker is a good starting point to see what options you have. Another thing that you can do is look, if you're struggling at the moment and you want to reduce your monthly outgoings, is to look at extending the term of your mortgage. So effectively this will extend the period over which you repay the debt you owe, which means that your monthly payments will drop. This has a cost in the long term because you're obviously paying back that debt over a longer period, so you're paying interest for a longer period. So it's not a cheaper option overall, but if you want to reduce your outgoings at the moment, and that's something that you really need to do to be able to stay on top of the mortgage, then that can be an option. So then once you've dealt with your mortgage, or if you don't have a mortgage and you can skip that step, the next thing you need to look at is your direct debits. So you need to look at whether you're actually using everything that you're paying for each month. We're all guilty of signing up to services or things that we think we might use, but then we don't actually end up using. So whether that's a magazine subscription where you aren't really getting value out of it, or you're not really reading it, or whether it's a gym subscription where your cost per time of going is astronomically high because you're not using it that often. It's about looking at those things. But it's also about looking at the cost of your providers. So the golden rule is that if you haven't switched providers in the past year, then it's very likely that you could get a better deal. So quite often providers will offer you a good introductory rate, and that will last for a year. And then after that, the cost will go up. So this is everything from your energy provider, your internet provider, TV, anything like that, where you should be able to save money just by shopping around. You've got two options here. One is to just go to your existing provider and negotiate a better deal. This is a lower hassle option because you don't have to actually switch. With one phone call, you can negotiate with them and either change what you're paying for. So Sky TV is a good example where the costs often creep up gradually as you use it. So you could call up and identify channels or packages, parts of the package that you're not using, and work out where you could save money there. Or you can just ask for a reduction because the costs have gone up, and maybe talk about other offers that are out there that you could get, and negotiate down. If you're willing to invest a little bit more time, then you can switch providers altogether. So you can go to various comparison websites, look at the offers available for new customers, and switch away from your current provider. Obviously, this requires a little bit more paperwork, a little bit more admin on your part, but generally a lot of these services are quite easy to switch now. The switching process is much more seamless than it was previously, so it doesn't have to take that long. So the next area that you should look at is cutting what's called lifestyle creep. So this isn't looking at the essentials and the bills that we were talking about before. This is all the other spending on stuff. So it's discretionary spending, it's spending on all the fun stuff, for example. So if you think back to when you got your first job or when you were a student, for example, how much money you spent each month and what you spent that money on, and then you compare it to what you spend now, the difference between that, a lot of that is classified as lifestyle creep. So it's things like gradually spending a bit more on the clothes that you buy, or the holiday that you go on, or the meals that you go out, and the type of restaurants that you go to. Now, there's absolutely nothing wrong with this lifestyle creep. It's understandable that as people go through life and earn more money, that they're going to want to buy slightly nicer things or spend more money on things. You just need to make sure that it's manageable so that you're still living within your means, and also that you're happy with that spending. Sometimes until you analyse it and look at it, you don't realise how much you're spending in different areas of life. And so it's good always to check in and see what you're spending on, how much you're spending, and whether you're happy with that. But particularly when we're talking about recession-proofing our finances, it's a good way of pinpointing areas where you can make cuts. So that's not necessarily making cuts now. It might be areas where you're identifying that you could save money in the future. So it's good to just go through this exercise and look at your spending and see where you can make cuts. At the moment, it's a little bit trickier. Obviously, your past month's spending will not be indicative of what you usually spend because everyone's been in lockdown and been spending either a lot less money or just on much different things. So what you'll need to do is go back to the start of the year or maybe the end of last year and have a look at your bank statements, see what you're spending money on. Some bank accounts, online bank accounts now, have handy tools to help you break down and analyse your spending as well, which can be really useful, and you can look at where you're spending the bulk of your money. And then finally, your other option, once you've gone through, you've paid off your debt, you've bolstered your savings, and you've worked out where you can cut your outgoings. Another thing to look at is how you can generate more income. So lockdown, particularly if you've been furloughed, can be a good time to start a business or get a side project off the ground. Lots of people have ideas of things that they want to do or switches in their career that they want to do. And so based on our own research, 5% of people have already started a business on the side during the crisis. And that's actually higher among younger people. So it rises to 10% among 18 to 34-year-olds. And this is where you're either turning a hobby into a business or you're starting a company that you had always wanted to, but you never felt like you had the time or the opportunity to do it. Another option is to retrain or add to your skills. So this means that if you do need to apply for work in future, you'll have newer skill sets or a different range of skills, and you can use some of the time to retrain. Or on a much smaller scale, you can look at other ways to generate money. So whether that's decluttering your house and then selling some of your stuff that you no longer use. So lots of people have things, quite valuable items that sit in their attic or are gathering dust that they don't use anymore, that they might be able to use some of this time to kind of declutter and generate additional income. So that concludes that part of the presentation, but now we will go to any questions that people have that they want to cover. So we've had a couple in ahead of the webinar, so I'll start off with those, and then we'll work through any ones that are sent in. So one of the questions that we've had in is, the government changes during COVID-19 mean that there's lots of help available to those with debt. Should I take a payment holiday? So I touched on this a little bit earlier, where I was talking about the payment holidays that you can get for things like debt, credit cards, mortgages, and that means that you don't have to make your payments in those months. The length of time that you're being given for a payment holiday varies depending on the type of debt that you have. So it gives you a bit of breathing space. So particularly if you think about your mortgage, that's going to be for most households, that will be your biggest cost each month. And so if you don't have to pay that out for 3 months, for example, then that means that you can get some breathing space. It might give you time to find additional work or to sort out your finances. So it's definitely a good option for people that are struggling at the moment, but it's not free. And that's the thing that people need to bear in mind. So during that payment holiday, however long that is, you'll still accrue the interest on the debt during that time, and you'll still have to pay that off in future. So how much it will cost you depends on how much you borrow, the interest rate you're paying, and for mortgages it depends on how long you've got until the end of that term of your mortgage, as to how much it will cost. So it's important to look into how much it will cost you, not just automatically take it, and work out whether you think that additional cost is worth it for your current circumstances, or whether you think you're better off holding off using it. The other thing that you need to talk to your bank about before you do it is the impact it might have on your credit file. So for mortgage payment holidays, there's been talk about how they will not have a negative impact on your credit report, but that it might be taken into account in future when you come to reapply for a mortgage. So you just need to be really clear on how it's going to impact you in the future, rather than automatically taking advantage of these payment holidays. So another question we've had in is, it says, I have saved money in lockdown, but where is the best place for cash? So the Bank of England cut interest rates right at the start of the COVID-19 crisis. They cut them to a record low of 0.1%. At the same time, more people are saving money. So we saw in those figures right at the start of the presentation that lots of people are saving money in cash at the moment. So the double whammy of those two things means that lots of banks and building societies that are offering a half-decent rate are attracting lots of customers, and there's less incentive for them to offer attractive interest rates. So one example we saw of this in the past couple of weeks is that Marcus, which is a digital bank offered by Goldman Sachs in the UK, it actually closed to new customers after seeing a big influx of both new customers and money coming in. And due to regulatory reasons, they decided to close to new customers. Now, if you're an existing customer of Marcus, that doesn't affect you, but it does mean that for people hunting for a good savings rate at the moment, that's no longer an option. And they took that action and weren't even the market leading interest rate out there. So there were people offering higher interest rates, but they still saw that influx. So all of this is kind of the backdrop to why cash savings rates are not very good at the moment, which is frustrating for savers. On the flip side of that Marcus story, National Savings and Investments, so NS&I, has cancelled some interest rate cuts that it was planning on. So NS&I is government-backed, as I'm sure a lot of people know, and it's one way of the government raising money for it to use. Now, at the moment, the government obviously needs to raise money to pay for things like the furlough scheme or the self-employed equivalent or other various costs of the current crisis. So one way that it's doing that is by making the NS&I products more attractive and taking in more people's savings. So, and people really like this because, particularly at the moment when people are a bit nervous, the government backing and guarantee to NS&I gives people some peace of mind. So at the moment, an account from NS&I is offering the highest easy access cash rate according to Moneyfacts. So it's paying 1.16%. So that's kind of the best you're going to get for easy access cash savings. Another option is you can get higher rates with things like regular savings accounts or current accounts. So look at other options that are out there and you might be able to get a bit more money. So regular savings accounts allow you to save monthly, but they offer, and so start that again. So regular savings accounts allow you to save monthly a certain amount. So you're restricted how much you can save each month, sometimes to 250 or 300 or maybe even £500 a month. But they offer a much higher interest rate. So at the moment, they're offering kind of 2.5% or 2.75%. So there are ways of getting higher interest rates. It just requires having a few more accounts and being a little bit more organised. Someone else has asked, I've got spare time in lockdown. What other low-cost things can I do to sort out my finances? So this is a common thing that we're seeing at the moment. Certainly not everyone, but some people have more spare time in lockdown and they're using that to sort out their finances. So some of the things that we have already covered you could do, you could use it to switch bank accounts, a bit like we talked earlier. Or you could use it to organise other areas aside from what we've talked about. So things like, have you got enough protection in place, which is things like life insurance or health insurance or critical illness insurance. One thing that people always put off, but is a relatively low cost task to do, is write your will. Lots of people think that they don't need a will, but actually they do, and it will be very useful to have one. So that's another task that you can tick off your list. You can do things like we talked about earlier, kind of sorting out your house, decluttering and selling things on eBay or Facebook Marketplace. Or another useful thing you can do is switch your pension to a cheaper provider. So lots of people have built up various different pension pots as they've moved around different employers, and so you could consolidate them all in one place or just switch them to a cheaper option. So someone has asked, how should investors position the diversification of their portfolio during an impending recession and adjust during the recession? What asset classes should I be allocating to? So this is a difficult one because there's no one-size-fits-all approach. Investors generally are quite gloomy on markets at the moment. So in our research, more than half of investors think that UK markets are going to fall further. But there isn't a clear route of this is what you should invest in to recession-proof your investments, or this is where you should put your money, because it really depends on how much money you've got, your own tolerance to risk, what you're investing for, how long you're investing for, what you're invested in at the moment. There is so many different aspects to it that it's impossible to give a kind of personalised plan or any clear tips. However, there are some general rules that you can follow. So the first one is to make sure that you diversify. So not just between different asset classes, but also between different fund managers if you use funds or investment trusts. So make sure that your money is spread well across lots of different areas, so that if we see a particular fall in UK markets, for example, not too much of your portfolio is disproportionately affected by that. Another factor is to look at concentration. So you want to look at making sure that not too much of your money is in one or two individual stocks. And particularly if you invest through funds, it's quite easy to see how you could invest in different funds that invest in lots of the same stocks, and you could end up having, through all of those combined holdings, you could end up having quite a lot of exposure to one particular company or one particular sector. So you need to dig through and have a look at that. You can check your cash levels. That's another good thing to do if you're a bit nervous at the moment. So if you want to, you can have cash to one side if you want to de-risk your portfolio, or if you think that you might want to buy in the future to take advantage of any falls in markets. But the big thing that you need to check is that you're not just hoarding cash for no reason. So some people at the moment are particularly nervous about markets, and so they think that it's just safer to stay in cash. And that's okay if you have a plan around that and if it's a kind of thought through process. But if you're just keeping it in cash and then attempting to time the right point in the market to put all of your money back into investing, then that's notoriously hard to do. And quite often you can end up spending so much time out of the market worrying about when to put the money in that you miss out on potential returns. And then the final thing that you can look at is, if you invest in funds or investment trusts, is to look at so-called recession-proof funds. Now, obviously, no fund is entirely recession-proof, but there are funds that are set up to help protect against market falls. So they focus on spreading your money across different asset classes, so things like bonds and cash and gold, as well as stock markets, and they have the ability to invest different proportions in those asset classes at different points in time, and they will focus on reducing the falls in the market. So it's called downside protection. So effectively, if markets fall by a certain amount, these funds would aim to fall by less. Now, they obviously can't guarantee to grow continually, but you would hope that they would fall by less because they've taken on slightly less risk. And we've probably got time for one more question. So one person here has said, is spreading my money into Bitcoin a good idea in the current crisis? So cryptocurrencies like Bitcoin became very popular a few years ago. Whether you should or should not invest in them depends entirely on so many factors: your own finances, your attitude to risk, your knowledge of Bitcoin and how it works, or other cryptocurrencies, as to whether it's a good option for you. So there's no real clear answer to that. I would say some caveats, some things that you need to think about is make sure that you understand anything that you invest in. So you need to fully understand what that opportunity is, how you'll make money from it, how that industry will grow, and where any growth will come. You need to make sure that you fully understand that before you put your money in, and that applies to anything you're investing in, but particularly to things that gain a kind of faddy momentum behind them, like cryptocurrencies have done. And particularly at the moment, I would say the other thing to bear in mind is to beware of scammers. So a lot of scammers operate in things like Bitcoin and cryptocurrency or Forex trading, for example. So you need to be particularly aware of where you're putting your money, how safe that is, fully research options, and really look into stuff. And particularly at the moment, there's been a big rise in people exploiting the current coronavirus crisis for scamming. There's been a big rise in kind of claims of people being defrauded or of scammers operating. So at the moment, you need to be particularly vigilant about these things. There's some kind of golden rules to follow of if you get called out of the blue or get an email out of the blue, then don't respond to those. Make sure that you do your own research. Don't be hurried into handing over your money for anything. and really take your time to research things and look over things before you commit your money to them. So thank you very much for joining us today. And as we mentioned before, the webinar will be available on the website. And if you had any further questions, then you can send them through. An email address will be sent out to you after the webinar. Thanks very much.